Tyler, your dreams have been dashed, but my dreams just got a little bit better.
We can call this a consolation prize because last time I checked, buddy, I own Brookfield Infrastructure too. It's just that you get to talk about Brookfield Infrastructure buying something that you wanted them to buy.
Absolutely. So what we're talking about here, Brookfield Infrastructure, along with its institutional partners, which we'll explain, just reached a $9 billion deal to acquire Colonial Pipelines, which is one of the most important refined products pipeline, getting refined products from Texas all the way through the Southeast, all the way up the mid-Atlantic. It is a massive 5,500 miles of distributing actual gasoline, diesel, jet fuel to the end markets. I think it's a great deal, and it shows why this relatively tariff-resistant, recession-resistant business in Brookfield Infrastructure just got a little bit stronger.
I know you just wanted to add that little bit of extra. Hey, anybody worried about tariffs? Guess what? Brookfield's the company for you.
Absolutely.
I know you want to get into it, so let's do this.
It's true. All right, let's talk about this deal and whether or not we think Brookfield Infrastructure is a buy right now, because love the business, love the stock are two different conversations. We're going to talk through that. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. It's fool.com/unscripted. Go to that link and you can get access to The Motley Fool's 10 best stocks to buy right now. Some of the stocks on that list right now are probably looking really compelling, but we got a good idea for this video too. All right, let's talk about the Colonial Enterprises. The jewel of that is the Colonial Pipeline. What just happened?
The Colonial Pipeline is one of probably like 3 or 4 pipeline networks in the United States that distributes the vast bulk of gasoline, diesel, whatever have you. It is basically like the only pipeline that runs from the Gulf Coast region all the way up to, I think, pretty much like mid-Atlantic, delivering gasoline, diesel, whatever have you. And considering the world where permitting of pipeline assets is harder and harder and harder by the day, the value of something like this continues to go up. I think there could be the arguments that gasoline and diesel demand is plateauing. It's not quite what it used to be, and maybe we don't need more pipelines, which sure, fine, but that doesn't undermine the fact that this is probably one of the key infrastructure pieces in the United States, which gives the owner of that pipeline some pretty decent leeway when it comes to negotiating rates for something like this. It's a interstate gasoline moving thing. I believe there's some actually regulations behind this, but it is the kind of business that, while maybe not the fastest growing thing in the world, is definitely going to be around for a long, long time, spitting out a lot of cash for its owner, provided, of course, that it's bought at the right time. And as long as you and I have been discussing Brookfield and the entities that it controls, one thing that I don't think we've ever said is, man, I think Brookfield overpaid for this. That's been quite a rarity. And it seems more or less that we're on the same page here, where this is a pretty reasonable acquisition, certainly on the price paid.
So speaking of the price paid, it's a $9 billion deal, which works out to about 9 times EBITDA. So EBITDA's earnings before interest, tax, depreciation, and amortization. This is important. This is a time where EBITDA is something that can help have context, because again, interest, taxes, depreciation, and amortization are real costs. They're real expenses, but post-acquisition, all of those numbers change, right? So looking at those numbers pre-acquisition versus what they're going to be as part of the integrated business does give us a little bit of a decent proxy for valuation. So that works out. So again, it's not super cheap here, but you're not buying a low-quality asset that needs to be improved here. You're buying one of the most important energy infrastructure assets in the U.S. and certainly in the Eastern U.S. Very, very important. Now, there's some important parts of the way this deal is structured that I think are critically important. And I want to talk about it. Number one, what is the value to Brookfield Infrastructure, the stock we're talking about, but also in terms of some of the advantages that Brookfield Infrastructure and some of its peer-related Brookfield entities share. So the way the deal is structured, again, $500 million is coming from Brookfield Infrastructure, and that works out to owning a 15% stake of that $9 billion total business.
Just to be clear, that $500 million is what you, the shareholder of Brookfield Infrastructure Partners, the publicly traded entity, that's our stake in this. We don't own the whole $9 billion portion. The infrastructure partnership that people own in their accounts is going to have this $500 million stake.
Right. Whether you own BIP or BIPC, which is the corporate equivalent to BIP, that's what you own a stake in. Exactly. Now, where's the rest of the money coming from? Very typical of Brookfield deals. It's institutional partners. In this case, the entire entities referred to as Brookfield Infrastructure are buying this. So what does that mean? That means that there's a very high likelihood that Brookfield Asset Management, ticker BAM, which is the asset alternative asset management business that's part of the Brookfield empire, which has about $1 trillion in assets under management, Tyler, there's a good chance that its infrastructure fund or one of its infrastructure funds is going to be the majority investor in this. There's probably other partners as well. Brookfield does a lot of business with pension funds. Other partners managing institutional money may also be taking a stake in this collectively under that Brookfield infrastructure name that they're calling it. So the point is, and this is where we get to the advantage what the Brookfield has. And again, we talked about the price at 9 times EBITDA. It's a fair price, but it's certainly not on the cheap end. But Brookfield infrastructure and its peer companies are a little bit advantaged versus a lot of the competitors for these large energy and infrastructure related assets. And the fact that they have that partner, Brookfield Asset Management, that's using cash, deploying cash, some debt too, but there's a lot of, again, $1 trillion in assets under management, sovereign wealth funds, pension funds, endowments, high net wealth individuals that are committing capital for 10 years at a time to Brookfield Asset Management to go out and find deals like this to generate yield, to protect capital, reduce the risk of capital losses, give exposure to these sorts of uncorrelated assets versus just investing in stocks or bonds. So that cash advantage versus using debt, which I promise you, there were multiple bidders on this, and most of them were probably going to be financing the majority of the transaction, which is a higher cost of capital, right? We're talking, depending on who you are, 5 to 8% additional cost of capital versus deploying cash for a deal like this. That gives Brookfield Infrastructure a big advantage.
Yeah, they're able to pay up, I wouldn't say a huge premium because you don't want to be overspending on assets like this.
That defeats the purpose.
Right. But it gives them the ability to go to them with an all cash deal. It's going to go a lot faster. If you look at some of the people who were looking to sell, there were some private equity companies. And, a story you and I have been following a little bit is like illiquid private equity companies having some people wanting to cash out during this recent market run. So there's probably some pressure to sell there. One of the big partners in it, Shell, was looking to free up some cash to invest in its business elsewhere. It seemed like the time was right to do it. Brookfield had the cash. They could move quickly. They could move efficiently and get one of these sort of deals done. I'm sure if other people were looking to go to the market to do this and would have to raise capital through debt, through partners, things like that, it might be harder today. And so having that, perhaps one of the more overused terms in private equity, but having the dry powder, if you will, to do these sort of deals, it has been immensely important. And for all the kind of hand-wringing I sometimes have about the somewhat complex nature of Brookfield's, the partnerships and the private funds and all the things that they own, that those large entities that are somewhat related have immense buying power, and you can kind of carve it up against across multiple funds, multiple publicly traded things or private things, or owned on the balance sheet itself of Brookfield Asset Management for until it can find a fund to deploy it into. These are all like, it gives it it can eat a pretty big elephant when it comes to these sort of things. And the Colonial Pipeline being a $9 billion deal that they can just write a check for goes to show that. I can think of only one other person right now that could make a $9 billion deal without even sweating it. And they just happen to reside in Omaha, which I think you and I will be going to in a couple days.
Yeah, no, that's exactly right. This is pretty high level stuff to be able to just buy it. And actually, interestingly enough, Brookfield Infrastructure, the $500 million stake that it's going to take in it, they're actually going to be paying cash as well. One of the things that they do is what they call capital recycling, where they have an asset that eventually at some point it gets up to a large scale. The growth prospects maybe don't meet their expectations for revenue or cash flow growth. And they find one of their institutional partners that wants to own that asset. They want to own that cash flow, and that steady state meets their needs. They sell it, and typically at a premium to whatever they acquired it for. They're really good at that. And they've done some capital recycling over the past year. And it just so happens they've got $500 million laying around that they're ready to deploy to buy their stake into it. So again, it's a really advantageous position to be in. Talking about Brookfield Infrastructure, the stock. So Brookfield Infrastructure, BIP, Brookfield Infrastructure Corporation, BIPC. I'm going to share on the screen and just use dividend yield as the proxy right now. We can go back to late 2023. The market was down a lot, and the stocks for these businesses were way down, which sent the yield up. But going back to mid 2021, which was not long after Brookfield Infrastructure Corporation was spun out. So basically the entire life of both these businesses, you can see that using yield as a proxy, this is about as good a time as it's been in the past 5 years to buy Brookfield Infrastructure.
I'll do you one better. And going further back, if we look at the history of this company, because, 5 years, pretty short time. And over the past 5 years, it's been a pretty wild time in terms of dividends and interest rates and all that stuff that would factor into this. But going back from like 2011 to 2016, 6% yield was more or less where this company traded in terms of valuation. So we'll call it like relatively fair valued at that period. We saw a long kind of decline in dividend yield from there, which meant like higher valuation. But so today at 6%, we're at not only a decade high in terms of yield, maybe excusing one brief couple of days in March of 2020 when everything was very low priced. But excluding that, you're more or less at like decade highs, plus right around the trading range that this company was at for a very long time, through like the 2010s. And based on that, and based on the growth that Brookfield Infrastructure has been able to give to its investors over time, that's a pretty compelling value for somebody looking for relatively stable dividends with a decent enough, better than inflation growth rate on that dividend payment.
All right, I mentioned tariffs was a starting point. Brookfield Infrastructure is not directly exposed to tariffs. Now, it is worth noting that some of those assets are producing things that might be exported, that might be being moved to export terminals. So there is some potential risk there, but that's more to its customers, because we think about assets like Colonial Pipeline. This is a fee-based business, right? They're just taking a fee to move the good from the refiner to wherever the owner of that refined product is asking them to move it to. So even in this case, its business is very relatively well insulated from the impact of tariffs. So it's not a zero risk, but it's low, and certainly not something that could upend the thesis or really put the dividend at risk. So I think that's worth at least mentioning as we wrap it up.